Welcome to the weekly update. We'll go over the action in the market for the week of October 24th through the 28th, and then we'll see how things look for the week of October 31st through November 4th. Now, on the daily charts, things are really showing a lot of improvement. In fact, we're actually turning positive on the daily charts. However, that's not quite bleeding over into the weekly charts. And a few points of concern are that we're showing a couple of charts that are extreme positive, which could lend themselves to the market actually reversing a little bit according to the weekly charts. So we'll go through and talk about that. So let's go back and talk about what happened in the past week. Earnings were really dominant this week. The idea that the Fed, which is meeting in this upcoming week, that they will raise interest rates 0.75%, that hasn't changed. What has changed is after that Wall Street Journal article a week ago came out, there's a suggestion that the Fed will go ahead and at least consider not raising interest rates as much in the December meeting. And that has really calmed down the markets. They feel, okay, at least there's something here that we can work with. And they tried to develop the scenario numerous times throughout 2022, only to have that dashed. Well, the way this whole article was written a week ago, it was by somebody that the Fed trusts to usually leak information as like a trial balloon just to see how the markets react. And so far, that's been acting well. Now, in spite of that, the market has then shifted over to looking more at earnings. Not only because they feel that they understand what might be happening, but because we're right in the middle of earnings season and a lot of major companies came out this past week. Unfortunately, a lot of those earnings reports were disappointing. Meta, which is Facebook, Alphabet, which is Google, Microsoft, Amazon, they had disappointing earnings that came out. And that's the part of the market that's really going to help us go higher. Those are the big growth, big tech companies that when these companies go up, that pushes the NASDAQ 100, as well as the S&P and even the Dow, all the indexes. It really helps to push those indexes higher. But on the other hand, there were some companies that came out with earnings reports that were taken rather well. Honeywell, Caterpillar, and then Apple, which had some problems a few weeks back with its phone sales. Once they came out with their earnings report, that seemed to help at least Apple a little bit. So small caps, and this is also positive because they're showing some strength right now. And a lot of times that will give some support to the mid caps and especially the large caps, meaning the S&P 500. Another thing that happened is President Xi in China, he secured a third 5-year term as China's leader. It's pretty much like, okay, and then when this 5-year term is up, he'll just give himself another one. So it looks like he's pretty much going to be their leader for the rest of his life anyway. Excuse me. And that's not necessarily a surprise because we saw the same thing happen in Russia with Putin when he was elected. And then when he fulfilled his term, well, he just created another office, stayed in that until his term limits or his term period was up. And then he went back to being in the other office. And so he's pretty much going to rule there for the rest of his life as well. But they're a little bit concerned because of the lockdowns and the zero COVID policy and the control that the government has over China, which that's not necessarily a surprise. It's how's that going to impact U.S. companies that do business in China. And then this is the other scenario that I was talking about, that the Fed will soften its approach after the November meeting. So that is kind of the scenario that the markets are going with. Now, there's a lot of things that could happen, but this right now is what the market is using to justify that they understand what's going on. And now there's a little bit more of a positive backdrop. This past week, the Bank of Canada raised its key rate, by 50 basis points. They had expected them to raise it 75 basis points. So that was less than expected. And then the ECB, or the European Central Bank, they did it as expected. They raised rates by 75 basis points. Some other economic data that came out, all came out on Friday, and the market could have just tanked on Friday on this news that I'm going to talk about, because it came in stronger than expected. And normally, a few weeks ago, the market would have just probably fell through the floor. Well, the fact that it received this stronger data, but it didn't decline, that's also a positive shift that we're seeing right now. And not only that the market doesn't go down because of that, but they feel that maybe all this bad news is already in the stock market or discounted already. Well, personal income came in a little higher than expected at 0.4%, where they expected it to be 0.3. Personal spending was up 0.6, where they expected 0.4. The prices, that stayed the same. So that gave a little bit of sanity to the report, or that was the same as expected, I should say. This is the one that could have just tanked the market. The core rate for PCE prices, they came in at 0.5%. They expected at 0.4%. So that was stronger than expected. That's more inflation based there. We also had the third quarter GDP advanced report that came out, and that was stronger than expected. So we have these previous 2 quarters now that were negative GDP, which that's the technical definition of a recession. Now it looks like we're having positive GDP, but we're still seeing a lot of data and speculation at this point that in the future, 9 months from now, the economy will likely go into a recession at that point. But GDP was stronger than expected at 2.6, where they had expected it at 2.3. The deflator, it came in at 4.1%, which was less than expected. This is more of an inflation gauge. They expected it at 5.3. And consumer confidence, still not all that high. It actually dropped or came in a little less than what they expected at 102.5, where they expected 105.5. Interest rates did fall during the week. And what was interesting in Friday's session is interest rates went up, but stocks also went up. And then there's a new prime minister in the UK after all that mess over there with their prime minister resigning after 6 weeks. They now have a new prime minister in place. Don't know much about this person, but at least it seems to have settled things down a bit in the UK. So for the week, the S&P was up 3.95% on above average volume. The technicals, they're turning a lot more positive on the daily charts. There's always things to worry about, and there's always things that you could focus on that are negative. We're seeing a lot slower move, where the daily charts, those are like speedboats that can change a lot quicker, where the weekly charts, they're like the big ocean liners that take a longer time to really turn and shift in a different direction. So, and then on top of that, we're seeing some overbought conditions on the weekly charts. The markets are still fixated on inflation and interest rates, but that's becoming less of an issue since the market kind of thinks it knows what's happening right now. So now it's kind of shifting more over to earnings. And then we have all the geopolitical concerns, Russia, Ukraine. This past week, apparently the 101st Airborne was deployed to Romania. I've read some different things about that, where, okay, they haven't been deployed since World War II, but there was another unit that was in Romania before, and they're just rotating that unit out and putting the 101st in. So so far, there hasn't really been a lot of talk about what will Russia do. Will they counteract with something, and then will the U.S. counteract with that? But even though this is a terrible situation, it could escalate even further. So we're trying to keep an eye on that one. In China, with the supply chain issues, they're not as much in the lockdown phase anymore. It's not as strict as it had been, but they're still, they want to get rid of all the COVID there. And I have the Fed speak in blue because they're currently in silent mode where they don't give interviews or speeches because they have their meeting coming up this week. Earnings are kind of the big driving force currently. And then the midterm election, we have that ramping up and will be happening next week. So that doesn't necessarily have a big impact on the markets unless something really surprising happens. And back in 2016, in the presidential election, the markets had pretty much guaranteed or really thought that Hillary was going to win. And she didn't. Trump ended up winning. And so the markets they tanked after that in the overnight session, but then they repurchased things. And from one day to the next, there wasn't that big of a change. A lot of the shifting took place overnight. And it's not that the market really cares one way or the other. It's just they set up things based on who they think is going to be in power. That changed. They had to readjust and rebalance things. And then we moved forward from that point. So we don't really know if that will really have an impact in the short term. Longer term, yeah, this could have some impact. There might be some policy changes and some things that really come through that do have an impact on the markets. Our trend is weakening, but it's still negative overall. And I'll have the ADX chart to show you. Just as a tongue-in-cheek type of humorous thing, the World Series, we're waiting to see if Philadelphia is going to win this series, because a lot of times when they're either in the World Series or they win the World Series, we see some real economic problems. As I record this, the series is now tied at 1 game apiece. So here's the week. Going way back over to the left-hand side, we did see a pretty nice up move on Monday and Tuesday. We gapped lower on Wednesday, tried to go up higher, but then fell back after that. Thursday was pretty much a yawner. I didn't even do a daily video for Friday, but Friday was the day when things really took off and we saw most of the gains for the week, and we ended near the high for the week, right at about 3,900. So just a little while ago, we were down in the 35s. Now we're up to the 39s. We want to see if the market can hang on to that right now. So for the week, the Dow was up 5.7%. The NASDAQ was up 2.2%. The S&P about 4%. And the small caps, led by the Russell 2000, were up 6%. And that was the strongest index overall. This shows how everything behaved during the 5 trading days of the previous week, with the small caps doing the best and the NASDAQ 100 and NASDAQ having the least. And a lot of that was earnings, because there was some real shakedowns in some of the stocks that reported. Then this shows how these indexes have been behaving since the all-time high set way back in January, and with the NASDAQ 100 and NASDAQ leading the way lower. If we're really going to shift over to a positive stance, we're going to need to see the NASDAQ and NASDAQ 100 turn more positive. They're showing some improvement, but they're not really turning as of yet. For the sectors, the sector that did the best over the week was industrials, followed by utilities, which have been getting hit pretty hard lately. And the financial sector did well. Real estate, which has been getting hit really hard, that did okay. All of the sectors ended up being up except for communication. And a lot of that was because of Google and earnings reports and just taking those stocks lower. And then this just shows how they all performed over the past week, with real estate doing the best, followed by utilities and industrials. With real estate and utilities, those are the ones that have been the weakest lately. Way over on the right-hand side, discretionary was up slightly. Energy, which is overall in the lead, didn't have quite as good of a week. And then communication was actually down in the 5 trading days of the week. They did update the current market valuation charts, so I can show those to you this time. We're currently fairly valued and right in the middle of the fairly valued look, where we're slightly above the dashed black line. So we're not necessarily extreme overall right now, but with the yield curve model, we are overvalued. We've really seen this spike up above the yellow line, and we're getting up to the 0 point here. So when it goes above the yellow line, that's considered to be overvalued. We're fairly valued with the Buffett indicator that compares stocks to GDP, where if we break above this yellow line here, we will become overvalued, but we're not there yet. The PE model that we're looking at, it came right back above this yellow line, so we're just slightly overvalued now. And you're going to see that if prices go up, that's going to tend to make the market more overvalued. Our interest rate model is, even though interest rates are going up and they're going up really fast, they're still very low historically. So they're currently fairly valued. And our margin debt, it was updated as of the end of September 30th. It is undervalued. When the markets go down, people don't buy things on margin as much. And so this could potentially be positive if we do start to turn around, that folks have some untapped capital that they might be able to use to help drive prices even higher. And the S&P mean reversion model, we're down below the yellow line, so we're now considered fairly valued. Sentiment, after Friday's session, we're getting over into the greed area. Now, when we use this chart, we really only use it as a contrary indicator when we show extreme fear or extreme greed. While we're looking at the middle parts of this chart, we tend to follow that and go in the same direction. And this is the historical chart just showing how sentiment has really improved after hitting those lows earlier in October. The active asset managers, after giving us a really extreme negative reading, has been showing some improvement. Still not necessarily high, but it is getting better. Here's the latest reading of the Ridex Bear Bull ratio. With the up day that we saw on Friday, we saw a real decline of those folks that decided to get out of the bearish funds. And so this reading, after giving us a pretty extreme reading, which when it gets really high like this, we tend to use it as a contrary indicator, it's really falling off. When it gets way down here to the bottom, that's showing excessive greed. And oftentimes we'll use that as a contrary indicator. So we're kind of about in the middle right now. The weekly survey of individual investors is showing some improvement, but overall they're still pretty pessimistic. We also have the latest reading, or the final reading, of consumer sentiment, showing that after getting all the way down to 50, it's showing some improvement, but this is still not a very good reading overall. People are just not happy with what's going on. If you look at the red chart, this is the 2-year yield, and we can see that as interest rates have been going up, a really wide spread between sentiment and the yield has really developed, and these tend to go in the same basic direction. Well, they're going, this is coming back up, but there's a real wide spread right now. Looking at the risky bonds versus the not as risky bonds, we actually ticked a little bit down in the latest chart. And then we're still below the black line, which means we're still doing okay as far as our financial conditions. When we get above this black line, that's when things are looking not very good. We're seeing a real inflow going into bonds, at least based on this Bank of America study. And if you think about it, that makes sense. For a long time, interest rates have been really low. And even though they're still low historically, they're a lot better than what you would have been getting. And so people are starting to buy back into the bond market. And that could really help bond prices go up and interest rates come down. Then this just shows the number of rate hikes that we've seen. There's been 35 rate hikes that happened in September, 19 in October. And so this is a global phenomenon. It's not just happening in the US. All of the central banks around the world are raising rates. This shows the heavy truck sales. When we're going down, that usually means the economy's having trouble. When it's going up, that's when the economy's more in a growth phase. Well, we are coming down, but we're still up here into the stronger sales area as of this latest reading. And then this is showing the different parts, or the different sectors in the economy that are contributing to GDP. And what we're looking at right now is this one way over on the right-hand side, where we have a lot of exports. And that's been having a little bit of trouble lately because of the exchange rate. The dollar has still been holding up quite well, but that still is leading to a large part of GDP. Then we have government spending, and then the green area is business investment. The gray is consumer spending. And then this other light blue area, housing, and then inventories. And you can just see over a period of time how this has shifted, where there are different parts of the economy that lead GDP either higher or lower. Then this, I'm not going to spend a lot of time on this. This is just saying that in the past 16 Fed rate hike cycles, going back to 1954, the average rate has been up to 5.7%. So, and we're well below that right now. Then this is saying a long journey downward ahead for U.S. equity returns. This is more of a negative chart. This is a 10-year annualized return chart, just showing how things have been coming back down. And if this trend does continue, that could suggest that into the future, we might see lower stock prices. And I'm not quite sure what to make of this, because it seems like these folks get it wrong, but a lot. But the professional forecasters, the probability of a recession in the 4 quarters ahead, so a year from now, it's still very high currently. But look at other times when they were either right on or way off or late to arrive at their conclusions. So not quite sure about that one. And then, of course, all of you remember 1788. Yeah, that was a pretty rough year. Actually, it was a pretty good year. That's the year that the Constitution was ratified. But this is just saying the bonds have had their worst year since 1788. Yeah. All right. FactSet just had one blog post. They're saying that companies in the S&P are reporting a lower net profit for the 5th straight quarter. And you see this first kind of grayed area. That's the quarter that we're talking about now, where earnings are coming in lower than they had been in the previous quarter. They're looking a little more positive going out, but that's always open to be changed or modified. Our VIX, since we had an up week, it continues to fall. It was giving us kind of an extreme reading overall, and it's really been falling. On the daily chart, it's fallen so much that we're actually oversold, which that means that the VIX could go up. When the VIX goes up, that usually means stocks are going down, but that's more of a short-term basis. The Ulcer Index, this is still showing that there's a lot of fear in the market, where the daily chart, we're below the moving average. So I'm not quite sure, because all of our fear gauges are looking a little more positive right now. And then if you want to see the updates of the possible positive scenarios, please check out the daily videos, because I update those each day that I do a full-length video. Looking at the backwards PE ratio based on the Shiller PE ratio shows that on a historical basis, we are still overvalued. We're at 28.75, where the median and the mean is between 16 and 17. So historically, we are expensive. We're still doing okay when you look forward, even though I don't have a chart to show you. There are some charts that I've shown recently that are a lot kinder to prices moving higher. This is what it looks like for the upcoming Fed meeting, that there's an 82.2% chance that they're going to raise rates 0.75%. They're at 3% now. After this meeting, they'll be at 3.75%. You still have some holdouts over here, because you have economists that have their theories and have their reasoning, and there's 17.8% of them that think we're only going to raise it 50 basis points, because that's what Australia did. That's what Canada did. So that's why they are over in this other camp currently. We're still seeing the Fed balance sheet decreasing as bonds expire, as tightening and tampering and all that other stuff starts to happen. So the Fed balance sheet continues to decrease. Looking at breadth, we had a pretty solid week overall based on price and volume. We were able to move above the moving average based on price and volume, but these moving averages are still declining. So we want to stay above this and see if that moving average will start to turn up. With our advanced decline ratio, after giving us a pretty extreme negative reading, we are showing some improvement, but we're still below zero. New highs, new lows. We broke out a little bit, and so that produced some new highs. So our 4-period look at new highs, that's showing improvement, and our 10-day look at new highs and new lows is showing improvement as well. So internally, we're seeing some strength. The accumulation distribution right about on top of a declining moving average, but that did show some improvement. Our trend shows that the ADX is going down, so that's weakening, and we're dropping slightly below the moving average, but the red line is still on top. So this is a negative trend, and we're still quite a ways away from 20. So this would really have to drop, or the green line would really have to come up. We've actually switched over to positive on the daily charts. And our Arun, after giving us a pretty extreme negative reading, is still showing some improvement. When the red line's on top, that means sellers are in control. When the green line's on top, that means buyers are in control. And overall, this is showing a little bit of improvement. The mass index not helping us now. Here's a daily chart where we were able to break through a lot of resistance this past week. Here was a pivot level that we got above. We were able to get above the 50-period moving average and actually close near the high. So that's good. And it's right at 39.01. So we're right at that 3,900 level. We're getting a little bit above the midpoint with our trend channel and the pivot points. We still have a ways to go. We have to get up to close to 4,000 here to get back up to S1, but we are showing a little bit of improvement on an increase in volume. We're still negative with our 50-period moving average. That's going to take a lot to get that back. And our long-term trend, although we came up to the 50-period, actually this is a 13-period moving average, this could be acting as resistance, but we are showing some improvement. However, the trend is still down. The BPI is showing some improvement. After giving us an extreme negative reading, this has really been recovering and not necessarily extreme positive. Currently, our long-term Chaikin oscillator, after giving an extreme negative reading, is showing improvement. Chaikin money flow also showing some improvement. The force index, it might be a little hard to see, but there's a little tip there that's green, so that is turning positive. This is one of the concerns. We have the McClellan oscillator at an extreme positive reading. So this will need to work off somehow, some way, usually by going sideways, if not an actual decline. And the summation index based on price and volume, we are seeing improvement based on price after giving an extreme negative reading. We're looking a little bit better. We're actually positive based on volume. In our oscillators, some are starting to turn up while others are still lower. So we're kind of getting a mixed picture here. This is another concern with our Swinland trading oscillator. We're getting extreme positive based on price, and we're getting close based on volume. The PMO is declining overall, and after giving an extreme negative reading, is showing a little bit of improvement based on price and volume. The PMOs that are rising, that's looking a little toppy, as are the buy signals. We're still showing a more positive move with the PMOs that are above zero. The RSI is showing improvement, but remains below 50. The special K still above the moving average, but this is declining. Where on the daily chart, the special K is trying to turn up, but it's still a long ways away from its moving average. The Stochh RSI, that's looking more positive, and the Williams percent R right at about 50. That's the midpoint, so that's showing improvement. The vortex is still negative, but we're seeing the green go up slightly and the red is kind of flat. Actually, both of these were more or less flat on the week. Ultimate oscillator showing some improvement. Money flow indicator showing some improvement. Bollinger Band's just about at the midpoint currently, so that's a neutral reading. The KST, after trying to cross over positive, is still slightly negative, and it takes a lot for this thing to move. PPO trying to show some improvement, but it's still negative until it crosses this moving average. The rate of change going back 1 week, we almost got extreme, where we're coming off of that in the current week. And looking back 50 periods, we got extreme negative and we're starting to show some improvement. The Copic curve not giving us a signal on the weekly chart, where we're still using that as an active signal on the daily chart. This is also quite encouraging. This is a weekly chart of the 200-week moving average and the fib retracement levels. After the 50% level held up and the moving average held up, we've actually been able to close above this 38.2% retracement level. That's pretty significant. And since this is a weekly chart and these are long-term indicators, that could suggest more positive things, at least currently, for the market. Our Heiken Ashi is looking more positive with open candles. The Kegi, that's black, it switched back to positive. The Renko, though, is still looking negative. The ease of movement going back 1 week is showing an improvement, but we're still declining when we go back 14 weeks. Point and figure also generated a new signal with some new X's. This is a double top breakout, where on the daily chart, we're also showing improvement, and it's called a bearish reversal, where things were looking pretty bad, and then the market was able to reverse and draw some X's. So that's looking better. And then we can combine that with the double top breakout that we have here on the weekly chart. We're showing some improvement with the leap 3 line break. Our Elder Impulse has switched back to positive for the S&P, but the SAR with the dots on top, that is still negative. And looking at the different indexes, we see how the S&P has been rebounding. The mid caps, which held up better on the way down, they're still looking good, and they still have a pretty good looking chart overall, but they're not really breaking out yet. And the small caps are also starting to show a little bit of life. All stocks, even though we're in a downtrend, we did see some bounce this past week, and you're going to see that a lot. Here's the mid caps still in a downtrend, but closed above the moving average. Small caps, the same thing, downtrend, but above the moving average. The Dow, which has the best looking chart right now, it really saw some strength. It's coming up to its 50-week moving average, which would be a 200-day moving average. And we're seeing that on the daily chart as well. Can that break above this and eventually get to the point where we see a golden cross? The NASDAQ, it still has a lot more repairing to do. It's in an overall downtrend. NASDAQ 100, kind of the same thing. Maybe this support level held up. We're seeing a little bit of a bounce here, but we are in an overall downtrend. The Wilshire came right up to its 13-week moving average. So this is showing some improvement, but still in a downtrend. NYSE closed slightly above the moving average, but still in a downtrend. The FANG stocks, they had a down week, because a lot of that is the big tech companies that disappointed. But ARK bounced up a little bit, but it still has a ways to go even to get back to its moving average. So it's still in a pretty solid downtrend. The 30 biggest software companies did have an up week over 5%, but are still in a downtrend. The Dow is showing how there is some improvement based on price, but the transports aren't really breaking out yet. That's a little bit of a negative divergence. We're seeing some bounce back with the utilities, but they really fell a few weeks back, and that took them lower pretty significantly. The CRB index, we're still waiting to see if there's going to be a death cross here. We're still hanging on to an uptrend, and even though we're a little changed on the week, copper is pretty much moving sideways right now. After really falling down, it's been chopping back and forth sideways. Gold, which continues to be in a downtrend. Silver, which is also in a downtrend. Oil closed up a little bit at 87.90. And the dollar, which topped out over 113, it actually is falling. And that's probably what we're going to see. If stocks continue to go up, we're probably going to see the dollar coming down. Although that's not what happened in Friday's session. They were both up. Our bond index, it was up slightly based on price, but we're still in a pretty significant downtrend. Here's our MOVE index, which is the VIX of the bond market. After really spiking up last week, has been coming down slightly, showing a little less volatility. Here's a daily chart of interest rates, how we've been going up overall. They were declining, but then in Friday's session, they did turn back up. And to see interest rates and stocks go up together is not what we've seen for a while. Here's a weekly chart showing the international rates, where the UK really bumped theirs up because there was all that freaking out that was going on. Well, their rates have come down slightly. The US rates have come down slightly, and Germany has declined, where Japan still remains pretty much flat. Our relative studies, oil is still the strongest performer in 2022, followed by the dollar, where you have gold and stocks, even though they're showing some improvement, are still down, and bonds are down. Going back to the beginning of the year, the bond to stock ratio is showing a decline overall, even though we still are trying to hang on to an overall uptrend. This could possibly cross below and be a death cross for a negative trend. Monthly chart just shows that stocks have really been outperforming bonds so far for the month. And gold has been underperforming the dollar. That's why you're seeing this going down. And gold to the S&P, where gold still continues to really struggle, where the S&P has been going up. So that's why we saw a real decline in this ratio. Low volatility stocks, not a really big change. They're still in an overall uptrend. The growth to value saw a decline. This is not necessarily encouraging right now. We want the growth stocks to turn around and go back up. That will help the indexes to go higher. And this chart just shows the value is still outperforming. And the same thing with the NASDAQ 100 against the S&P. It is underperforming and in a downtrend. The S&P 100 to the 500 also showing a lot of weakness now. So these aren't necessarily encouraging at the current time. Discretionary is also starting to fall in the ratio compared to staples. And then energy, which has been doing really well, and tech, which has really suffered. Energy has really been outperforming. So what's our outlook? The major economic reports coming out. Not a real major one on Monday, but it's kind of the only thing coming out is the Chicago PMI. On Tuesday, we do have a biggie. ISM manufacturing, construction spending will come out. Then we have our weekly mortgage applications index. And then the big one at 2 p.m. Eastern will be the FOMC announcement. The markets will gyrate. Then they'll have the press conference after that, where the markets will hang on to every word of Jerome Powell and try to read into any secret meaning that they can. On Thursday, we get our weekly jobless claims, and then the other big report will be ISM manufacturing before we get set for the big report on Friday, which will be the employment situation report. That usually comes out the first Friday of each month, and we will be into November by then. And then the technicals on the daily charts, they're switching more positive. And you can see on our weekly charts here, they're still more negative, even though some of them are showing improvement. We're going to need to see growth start to turn around. Inflation and interest rates, that's still a fixation, even though the markets feel that they kind of understand what's happening currently. The whole list of geopolitical concerns, and then, of course, the midterm election that may or may not have any kind of an impact. So our scenarios, we're not really going with the down scenario. This is based on the daily charts because things are turning a lot more positive. However, on the daily charts, we're short-term overbought. We were that way for a few days last week. Well, with Friday's advance, we're even more short-term overbought. So we'll have to see. Are we going to see a bit of a pullback? If we do, what's the intensity of that pullback going to be? Is it going to change the climate or just work off some of the short-term overbought conditions? So we're going right now with the up scenario because the technicals are more positive, but short-term overbought. Some of our scenarios on the daily charts are showing improvement. Our sector rotation, that's not really helping us right now. We're just not seeing an awful lot of follow-through with that. And we're seeing some improvement with our positive setups. The technicals are improving. We're regaining some moving averages on the daily charts. We've regained pivot and fib levels. And then other areas of resistance, we've been able to break through that. Now, if we start to fall, will the market use some of those areas that were once resistance and we broke through? Will they be support if we come back down? And we're not really going with the sideways because both on the weekly chart and on the daily chart, we're still above 20. It's a positive trend on the daily chart where we still have a negative trend on the weekly chart. But in both cases, those trends are weakening. So thank you. Have a wonderful week. I will be posting the intermarket analysis update shortly after this, and I hope everything goes great for you. And I'll prepare the weekly video next weekend.